Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into some fascinating data from the first quarter of 2025 that shows a significant rebound in Canada's mortgage market. According to TransUnion, mortgage originations jumped 51% year over year. That's a big leap, isn't it, Janine?
Absolutely, Steve. It's heartening to see such a recovery. The total Canadian consumer credit balances reached $2.52 trillion in the second quarter of 2025, marking a 4.4% increase from the previous year. However, when we adjust for inflation, the growth is a more modest 3%. It seems like rising prices are a major factor here, rather than just an increase in borrowing.
That's an important point, Janine. And it looks like subprime consumers are feeling the pinch of higher living costs more acutely. Matt Fabian from TransUnion Canada pointed out that these consumers might be taking on additional debt, like credit card balances, to manage the costs of goods and services.
Yes, and it's interesting to note that the housing market rebound is driven by younger buyers. Millennials accounted for 41% of all new mortgages, and Generation Z is the fastest growing segment with a 66% year-over-year growth. It's clear that lower interest rates and regulatory changes from 2024 are playing a role in this renewed demand.
Despite this increased activity, affordability challenges remain. The average new mortgage loan amount climbed 6.9% year over year to $368,432. British Columbia and Ontario are leading the way with higher averages, thanks to the persistently high home prices in Toronto and Vancouver.
Yes, and the credit landscape is showing some regional disparities. Alberta, for instance, recorded the highest serious delinquency rate at 2.29%, which is up 11 basis points from last year. Meanwhile, Quebec has the lowest delinquency rate, but it's still seen a slight increase, possibly due to elevated unemployment.
Inflation's impact is quite varied across different credit tiers. While superprime borrowers saw a drop in their inflation-adjusted balances by nearly 33%, subprime consumers experienced a 15% increase. This really highlights how rising costs are disproportionately affecting lower-income households.
Looking ahead, there's an important consideration for many Canadians. Over 2 million mortgages are set to renew between 2025 and 2026. Many of these were initially secured at ultra-low rates near 1%. And these borrowers will likely face significantly higher monthly payments.
That's a critical point, Janine. Even though there are encouraging signs of economic recovery and easing inflation, the Canadian credit market remains fragile. Financial institutions need to stay vigilant, especially as mortgage renewals accelerate and regional economic pressures increase. Let's turn our attention to the growing interest from larger investors in Canada's mortgage investment corporation space. This trend indicates a significant shift in the investment landscape, particularly for institutional investors who are eager to explore new opportunities. What are your thoughts, Janine?
It's quite intriguing, Steve. The private and mortgage investment corporation lenders have been steadily increasing their market share in Canada. Now, with larger institutional investors showing interest, it seems that these sectors are gaining even more traction. This could open up new avenues for borrowers who may not fit the criteria of traditional lenders.
That's right, Janine. Benjamin Sammet from Dabble Capital Advisory highlighted that institutional investors are looking for more standardized, easily accessible products. Instead of conducting extensive due diligence on individual mortgage investment corporations, they're interested in a more homogeneous product that provides a clear understanding of the investment.
And this shift could be beneficial for borrowers, too. With conventional lenders maintaining conservative lending criteria, more borrowers might turn to the private and mortgage investment corporation spaces. This could provide them with the flexibility they need, especially if regulatory bodies like the Office of the Superintendent of Financial Institutions continue to tighten lending regulations.
Indeed, and with the Bank of Canada potentially making further policy changes, we could see even more Canadians exploring these alternative lending options. Samit mentioned that as mainstream lenders remain conservative, the institutional appetite for the private and mortgage investment corporation spaces is likely to grow.
It's also important to note that the borrower profile in the mortgage investment corporation sector is evolving. Unlike the perception of being a lender of last resort, these entities are now dealing with prime borrowers who have strong credit scores and favorable loan-to-value ratios. This evolution is helping to mitigate some of the risks associated with these investments.
That's a key point, Janine. The Canada Mortgage and Housing Corporation has observed that the largest 25 mortgage investment corporations are taking steps to manage risk, such as increasing loan loss allowances and focusing more on single-family homes. These measures are crucial as they help maintain the stability of the sector.
Absolutely, Steve. As the space continues to attract more institutional attention, it remains a valuable source of business for brokers. With fewer documentation requirements and quicker turnarounds, brokers are finding it an attractive alternative to traditional lending avenues.
It's clear that the mortgage investment corporation space is poised for continued growth. As more investors and borrowers turn to these alternative channels, it's essential for brokers and financial institutions to adapt and stay ahead of these trends. Now let's delve into a topic that's been creating waves in the Canadian fixed income market: navigating central bank divergence amid the Bank of Canada's easing and trade uncertainty. This is a crucial subject for investors looking to make strategic entry points in the bond market.
Absolutely, Steve. The global central bank landscape in 2025 is quite the mixed bag. We've got the U.S. Federal Reserve maintaining a restrictive policy rate between 4.25 and 4.5%, while the European Central Bank has eased to 2.25%. The Bank of Canada, in comparison, is sitting at 2.75%, trying to walk the tightrope of a fragile economy and volatile trade environment.
Right, Janine. This divergence presents both opportunities and challenges for Canadian fixed income investors. The Bank of Canada, or BOC, is caught in a delicate balancing act. They have to weigh the risks of U.S. tariffs and inflation pressures against the need to support economic growth. Their cautious approach means investors need to be strategic in their bond market positioning.
It's a tricky situation indeed. The BOC's July 2025 Monetary Policy Report highlighted internal divisions within the bank. While the overnight rate was kept at 2.75%, there was debate over whether to cut rates if inflationary pressures eased. There are concerns about cost-push inflation from U.S. tariffs, which makes for a pretty nuanced playbook.
And it's not just the internal divisions, Janine. The ongoing U.S. trade conflict is a significant factor. Tariffs on Canadian steel and aluminum have already hit export demand hard, with a projected 1.5% GDP contraction in the second quarter of 2025. The BOC's three-scenario framework, current tariffs, de-escalation, and escalation, really underscores the uncertainty facing the market.
The potential for GDP growth in the second half of 2025 is there, but if an escalation occurs, it could prolong economic weakness. For bond markets, this means yields will remain highly sensitive to trade developments, and the BOC might delay cuts until some of these risks crystallize.
Meanwhile, the Fed's tight stance is putting pressure on the Canadian dollar, which has weakened by 12% this year. This has increased import costs and could lead to capital outflows as investors chase higher yields in the U.S. It's a challenging environment, but there are strategic entry points for investors.
Investors could benefit from positioning in long-dated government bonds, as the BOC suggests a potential terminal rate of 2.25% by late 2025. High-quality corporate bonds, especially in sectors insulated from trade disruptions like healthcare and utilities, also offer attractive yields.
And let's not forget about currency hedging. With the Canadian dollar's depreciation, investors with U.S., dollar liabilities should consider forward contracts or CAD-pegged bonds to mitigate exposure. Monitoring trade data and inflation metrics will also be crucial in anticipating the BOC's next moves.
It's all about balancing caution with opportunity. The BOC's policy path is a delicate act of supporting a weakening economy while managing inflation risks from trade tariffs. Investors need to stay agile and ready to adjust based on evolving trade dynamics and inflation trends.
Well said, Janine. As the next rate decision on September 17th, 2025 approaches, it's clear that patience and precision will be key for investors navigating this complex landscape. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.